Anna Marie, just confirming you can hear me. Vander.
Yes, I can.
Thank you very much.
You're welcome. Good morning.
Hi, this is Jeff Sparks. Don or Vanden, can you confirm that you can hear me and my audio is working?
Sure can,
Sounds
Jeff.
good, Jeff.
Thank you, guys.
Put on
And good morning, Vicki. I heard you also well.
Yes, good morning.
Hey, Vicki.
If you could
Okay.
speak a little more into a mic or a little louder, it would be good, I think, for presentation.
Yes, can you hear me now? How's that?
You're all right,
Good.
Don? Yep.
Yeah, I'm good.
Am I good? All right.
Yep.
Yeah, I'll get a little closer. How do you guys get your camera so dead centered? This is challenging.
Well, I move it around a lot during the day.
Experience.
You got to hold your position, yeah.
Hey, Don, one more housekeeping item. I just sent you an email with the Q&A items. Make sure you see.
Thank you.
Okay.
Okay.
Jeff, do you love that new IRS notice that came out? No deductions?
Thank you. I forgot to add that to my talking points. I'll put that in right now.
But this shouldn't affect tax exempt, should it?
You're right. That's why I didn't add it. You're right.
Yeah, don't add it, but I mean, it was, what a kicker, you know?
I know. We're hoping it doesn't stand and it's challenged.
Yeah,
We think Congress might
yeah.
keep it.
Like I said, not a concern for tax exempts, but gee whiz.
I tell you what, we'll give it just one more minute and get started here.
Yeah. Oops. Camera back up. The number is going up, so people are catching up now. Am I getting a minute? Yeah. We seem to be. Yeah, the number's jumping up. Here we go. For those of you in St. Louis, I hope it's brighter. I'm living in Illinois. I hope it's brighter on the west side of the river than it is on the east side of the river.
No, it's dingy today.
It's dingy here as well, so that's a good word for it.
It's bright and sunny here in Southern California.
Oh, all right. I didn't ask
I won't
you.
rub it in.
Well, Don, do you think we should get started here?
You know what, Vander, let's give it a little, I see the number jumping up real quick here. Okay, let's give it maybe another 30 seconds or so. It seems like people are catching
Sounds
up to
good.
this.
Give it till 10:32 here.
There you go, and then you can dive in.
Well, hello, everyone. This is PPP session number 2, I guess I would call it, for those who have either received PPP loans or are hopefully awaiting round 2 PPP loans. My name is Vander Corliss. I'm the CFO at the United Way of Greater St. Louis. I've been here 18 years, the CFO for the last few of those. We have quite a number of people have availed themselves of this session today. About 150 participants on the call, with a lot of names that I see that are familiar, both in United Way world and in Jewish Federation world. And we've got some other friends also. And it's my presumption these are clients of either Reuben Brown or Thompson Coburn, our presenters today. Our four organizations are thrilled you're with us today, and we're thrilled to be partnering to provide this information to you. So I welcome all of you to today's session, and I'm pleased to introduce Jewish Federation of St. Louis's Chief Operating Officer, Don Hannon, who will introduce our presenters today.
Great. Thanks, Vander, and thank you everybody for participating today. We really do appreciate the partnership with the United Way of Greater St. Louis. You know, one of the few benefits I think that's going to come out of this unfortunate time are going to be some of the long-term partnerships that have either been developed or strengthened through this process. I think it's good for the community long-term. So we'll take that as a positive as we move forward. I want to introduce our panelists today. We'll try to help us navigate this emerging, confusing legislation and resulting guidance. Our first presenter will be Jeff Sparks. Jeff's a partner at Reuben Brown here in St. Louis. He's in the Entrepreneurial Services Group. He serves privately held organizations and private equity portfolio companies specializing in manufacturing, distribution, service technology, and healthcare industries. Most recently, Jeff's helped the firm lead the COVID-19 relief efforts in their response to the Paycheck Protection Program. Our other speaker comes to us from sunny California. Like I said, we won't make fun of her. Vicky's a partner. Vicky Gilbert. Vicky is a partner at Thompson Coburn as I said, in the Los Angeles office. She's a commercial finance attorney, represents banks, investors, and borrowers in a wide variety of transactions and investments. Vicky's clients include banks, finance companies, venture capital, insurance companies, borrowers, etc. In addition, she has substantial experience with sports franchise financing, representing lenders. No comments will be made about the Rams. So I promise not to bring that issue up for those of us in St. Louis. We want to thank Vicki and Jeff and their firms, Reuben Brown and Thompson Coburn, for spending time with us this morning. Because PPP guidance is still evolving, we may have some gray areas. Vicki and Jeff will try to help us navigate through these gray areas as best we can. Our panelists will share some information to begin, and then after that, we'll open the questions for participants. We ask that you submit your questions via the chat function in the Zoom application. I would be remiss if I didn't say, as a reminder, this video conference is meant for informational purposes only. You should consult your attorney or accountant before making any decisions regarding the Paycheck Protection Program or any information we share. With that, I hand it to Jeff.
Thank you, Don, and thank you, Vander. And we very much appreciate the Jewish Federation and the United Way hosting today's seminar and inviting us to speak. We're grateful for the opportunity to be able to speak in front of so many organizations that truly do so much good in the St. Louis and the regional community. So thank you for all of your work, especially in this challenging time. And thank you for having us out today. I've been asked to spend some time talking about the forgiveness portion of the PPP loans. So what was it, 2-3 weeks ago, maybe even a month ago at this point, we hosted a webinar. Jewish Federation and United Way hosted a webinar for the same group to talk about essentially how to get a PPP loan. So we're making the assumption at this point, people on the call have gotten a PPP loan, or if you haven't yet, act immediately because there's very limited funds left. So today we're going to be focusing just on the forgiveness side and what you should be thinking about now to make sure you maximize your forgiveness opportunities. Or at least, sorry, that's the part I'll be speaking about. And then Vicki will be speaking about some other items within the PPP considerations. I'm going to go ahead and I will mention as well, a lot of questions did come in prior to the presentation. We've done our best to incorporate a lot of those into our talking points today. The ones that we didn't incorporate, I believe Don is going to do a Q&A with at the end. So if more questions come up, as Don said, just throw it in the Q&A, or sorry, in the chat feature, and we'll do our best to answer those questions. It's 150 people is, I guess, a relatively small group these days for these presentations, so we'll keep it as conversational and informal as we can. I'm going to go ahead and share my screen. So that way, oh, the host is disabled screen sharing. So Don, if you're the host, if you can enable screen sharing, that'd be great. I can't hear you, Don, you're on mute.
Anna Marie, can you do that, or I need to do that?
Well,
I'm working on it.
while they work on that, I'm gonna jump right in here so we don't waste any time. And I will mention today's time is very limited. We only have an hour together. I could speak for easily 3 hours on this topic. So I'm gonna hit the high points, and that's all I'll be able to cover today. As Don mentioned also, we do need to disclaim and say this is general guidance, and what I'm mentioning here shouldn't be acted upon without talking with your advisors first. And I'll tell you, these rules are very challenging and very difficult when you peel back the onion. If there ever was a time to be utilizing your CPAs and your lawyers, now's that time. Due to the large dollar amount at stake on these loans, even the littlest of issues can potentially jeopardize all of your forgiveness. So we do highly recommend that you do reach out to your individual counsel on these issues. And give me just 1 minute, and I'm going to go ahead and share my screen here. And can you see my PowerPoint?
We sure can. Thank you, sir.
Great, thank you. And we will send out these slides after the presentation. So they're a little bit all-encompassing. They got a lot of detail on them. I'm not going to try to cover all the detail, but it's there since we'll be sending it out later. And we mentioned the disclaimer. So what I'm going to do in the forgiveness section is I'm going to talk about what we do know, what we don't know, and some of the SBA rumors that they've put out there. When we go into what we do know, I'm going to work hard to kind of cover the basics that was in the CARES Act. And that's really just the basics right now. When we talk about what we don't know, a few of those main things, one question we got in the previous Q&As that were submitted, I'm getting all over the places. Do you measure these forgiveness items, whether it's payroll, rent, whatever, is it on a cash basis or an accrual basis of accounting? That's probably the number one question I keep getting, on cash or accrual basis. And since I know we have a mix of people on here, I'll explain for a moment what I mean by cash or accrual. When I say a cash basis, that would mean in your 8-week period, is it just the money that you actually write a check for and that you spend in that 8-week period, regardless of when the service is performed? Or is it accrual basis, meaning it doesn't really matter when you write the check, as long as you incur those services in the 8-week period, that's what counts, and you can do it on an accrual basis. As of right now, the SBA and Congress has not answered that question. The most safe guidance that I could give you is it's really both a cash and accrual, meaning if you've incurred the expense and spent the money in the 8-week period, you got no problem deducting that cost or counting that cost towards forgiveness. But that would be a very high hurdle to both have cash and accrual. So you've incurred the expense and you spent the money. We do believe that they'll pick either cash or accrual or let the borrower decide, but that question hasn't been answered. So right now, I would say when it comes to tracking your cost, you really need to track both cash and accrual, or somehow have the ability to do that, because when the guidance comes out, we're not sure which method will be acceptable. The other question I'm getting is, hey, Jeff, in the meantime, we got to do something. Like, how should we be thinking? Originally I was saying, well, cash method seems to make the most sense because it's the easiest. You can go right to the support, right to the checks, right to the wires. But then as we, had people actually working through the rules, I was quickly bombarded with, well, cash doesn't make a lot of sense, because if you look at your payroll, if we have 8 weeks of time to incur these costs, and you look at the way payroll's paid, let's say payroll's paid on the 15th and 30th, you don't necessarily get, 4 payrolls in an 8-week period on a cash basis. On an accrual basis, you would certainly get 8 weeks of payroll in there. So I see where there is some inherent problems with cash, because at the end of the day, I do believe that you do want, a true 8-week period of expenses. So I think right now accrual is kind of the most logical answer because you get a good 8 weeks of payroll, a good 8 weeks of rent, et cetera, et cetera. So that's what I can share today on the cash versus accrual. I'm getting a lot of other questions.
If I have something to add on that issue,
Great,
and
thank
I
you.
have a very strong feeling. The statute itself, and every time a question comes up, I go back to the statute itself. And the statute says that the following costs incurred and payments made during the covered period go into the forgiveness calculation. And I think that's very generous, and I think that is the position people should take, so that if they have a payroll, if they've got a payroll that it takes place like 2 days after their 8-week period started, but it represents payroll that accrued in a prior period, I think you count that. I similarly think, and I know that's not going to be perfect, but the statute says both costs incurred and payments made during the covered period. That's how I would calculate it.
And you'll see even among practitioners, there's disagreement right now because we're looking at incurred and saying, well, does incurred mean, that's actually more of a accrual terminology.
Accrual term, right.
That means if you have a payroll that you paid 2 days in, well, incurred would mean the services for that payroll need to be within the 8-week period. So let's say you have a 15-day payroll, you pay it 2 days in, do you only get the 2 days worth of services incurred in that period? So you'll notice even amongst practitioners out here.
Yes.
And that's why we're sharing all views on this call today. And we're going to, both intentionally beat up each other at times because we just don't know yet. And there's still a lot of uncertainty out there. So thank you for pointing that out. The other question that we're getting a lot of is, when it comes to like rent, we get this question, well, can I just pay like 6 months of rent in the 8-week period and just have a bunch of prepaid rent? We think stuff like that will not be allowed. That seems to be a clear gaming of the system and not in the spirit of it. And that's also when we go to the whole incurred. So we do think that's going to be called out. And then another question we keep getting is, can I make bonus payments within this 8-week period? And, Vicki and I were talking yesterday, and Vicki pointed out, which I agree with, the statute doesn't say bonuses. It says compensation. I'll get to the exact wording in the presentation we'll get to. But bonuses, we need to be careful. To me personally, it seems reasonable that if you're paying a hazard bonus because you have a frontline worker that you could include that, but we just don't know, again, whether or not bonuses are going to be included because that still is a gray area of the rules. So hopefully that covered a lot of the Q&As that have already come in. The other thing that I'll mention here is the SBA is putting out all sorts of messaging around what these final rules will look like. And again, we'll talk a little bit more, but there's going to be final rules from the SBA on forgiveness. And they're putting out all this messaging of what it might look like. And a lot of that is, you're picking up bits and pieces. So people are getting worried based on what they're hearing. And these rumors are out there. So really the biggest thing that I want to stress, and if there's like one thing you remember from today's presentation, listen up now, is that, because there's so much uncertainty around forgiveness, our advice is don't spend the money in a way you wouldn't normally spend it, and that makes good business sense. That way, if you don't get forgiveness, you're in no worse shape than you were prior to getting the loan. And that's really the best thing that we believe to tell clients and people is that, anything could happen on these forgiveness rules. They keep changing. Everything's in flux. So, I just make good business decisions with your money. Don't spend the money in a way you wouldn't normally spend it. And that's something that we're really trying to preach right now. I covered a lot in that opening slide. A few other things we want to mention here as far as the urgency goes. I keep saying this guidance. So what happens is when the original CARES Act was written, the SBA and Treasury had 30 days to essentially put out the regulations on how it's going to work. That 30-day time period ended on, I believe it was Monday, April 27th. We could all do the math and know we're after Monday, April 27th. So it's our read that guidance should have come out by Monday, April 27th. It is not. So we do firmly believe that the SBA and Treasury will be putting out more very explicit guidance, or at least we hope, more very explicit guidance on how to calculate forgiveness. And we go back to this bullet point here that they are required to do that. The other thing that I'll mention from a timing perspective is once your 8-week period ends, you'll submit your application to your bank, the bank that granted the loan, for your forgiveness. And then the bank has 60 days to approve your forgiveness. So what we anticipate, obviously, is right at the end, everyone's all going to submit their applications within a week of the 8-week period ending, because they're going to want to get clarity, and the banks are going to be totally overwhelmed. So that's something else to remember there. And when it does come time for the forgiveness, we'll talk about all these different pieces of forgiveness, but the application and the related documentation and the tracking is going to be very important, because that's what the bank will act on. And if the banks don't get clear, well done applications and tracking, it's going to make your case for forgiveness not so good. So we're suggesting you put a lot of effort into your forgiveness package, essentially, that you're going to be submitting to your bank. At Reuben Brown, one thing that we're doing is we are helping clients either do the entire forgiveness package for them and take everything off their plates. And when we do it in conjunction with talking to the banks, all the large banks in town we have relationships with, and we're saying to those banks, what do you expect to see in the package? And we're making sure if we're doing a package for a client, it matches up with what the bank's expecting to see. Or clients are doing their own package, and then we're double checking it before it goes in. So really we can either just do a double check or do everything for you. That's the kind of services that are being offered in this area. And the most important thing that I'll point out there is what I said is that, when we do these packages, we talk to the bank and say, what do you expect to see? So it's understanding what your banker is expecting to see in that package is really important there. With that, I'll flip to the next slide. And the proceeds of the loan, you can see here everything that it can be used on. The last two items on here, you'll note you can use the loan to pay these items. However, those two items are not eligible for forgiveness. So the biggest one on there is interest payments on any debt obligations. Those interest payments on any debt obligations won't be eligible for forgiveness. The only interest that is eligible for forgiveness is bullet 3 on there, mortgage interest payments. So if you're making mortgage interest payments, just the interest, not the principal, is eligible for forgiveness. But if you're making, there's payments on a line of credit or on a principal note, that interest is not eligible for forgiveness. So those are what you can use the money on. And in a few more minutes, I'll explain a little bit of detail on those items. Next up here, the biggest rumor that the SBA has put out, and I'll call it a rumor because nothing's been factually published, is if you don't spend 75% of your loan proceeds on payroll in the 8-week period, nothing will be forgiven. When we first heard the SBA saying that, we thought that's ridiculous, and we kind of just turned a blind eye to it and deleted the emails. Because it's so stringent, and it isn't, the CARES Act doesn't actually say this. But it's gained more traction, and bankers are advising to really watch out for that. So we are, thinking that we hope this doesn't pass. We don't believe it's the intention. We don't believe it makes sense. But, worst case scenario, we think that the SBA could come out and say if 75% of the proceeds aren't used on payroll, no forgiveness at all. If you get 74%, you get nothing. That's so scary. It will require a lot of maneuvering, but that is one potential that's out there. So we just want to alert the group of that. And it's why I go back again and say, forgiveness is almost the cherry on top. Use these funds in a manner that you would normally use them. When it does come time for loan forgiveness, the 8-week period, right now the 8-week period starts on the day you got the first deposit. If the bank made multiple deposits into your account for your funds, it's the day they made the first deposit into your account of the funds is when the 8-week period starts. We are hoping, everyone's reading, that potentially Congress and or the SBA will extend the 8-week period to 12 weeks or 16 weeks, or say if you're in a city, county, state where there's a stay-at-home order, your 8-week period doesn't start until the stay-at-home order is lifted. we believe that because stuff like gyms, restaurants, they can't even be open. So how do you have your 8-week period? But again, that's just all hope and good logic. It doesn't mean it's going to pass. What right now is it's that true 8-week period is when you need to spend the money. The next slide talks a little bit about, again, what qualifies for forgiveness. And this is somewhat duplicate to my previous slide on what you can use the money for. But you'll see payroll costs, the mortgage interest, the covered rent, and the utilities. So let's get into a little bit more detail about those items. So payroll costs, you can see here, we talk about salaries, wages, commissions, or similar compensation. As Vicki loves to remind me, and I appreciate her doing it, it doesn't say bonuses. So will salaries maybe naturally include bonuses? We don't know. We certainly hope so, but we don't know on that. And then you can see the other things that are included, such as vacation, sick pay, etc. What I do want to point out there is if you're getting a payroll tax credit for sick and or FMLA leave, so this goes back to the Family First Act that was like a month ago that almost seems like ancient history, where if your employees were taking sick or FMLA leave, you can get a payroll tax credit. If you're getting a tax credit on those wages, you can't count those wages again. It's a one-time counting of those wages. And we're getting a lot of questions too on that payroll. Is it gross payroll or net payroll? It would be gross payroll. So the gross payroll you pay somebody. And then also remember, payroll for any individual is capped at $100,000. And if you take 100,000, you divide by 52 weeks, and you multiply that by 8 weeks, you get $15,000. 385 is the amount of payroll for a single person within 8 weeks that would count. After that, it's capped. Going on to the next slide here, we talk about covered mortgage obligations. And you can see there are some details on what that is, and obviously in place before February 15th. There is some question there. Obviously, when you hear covered mortgage, you think about a mortgage on your building. Excuse me. You think about a mortgage on your building, that's kind of the natural thing that comes up. We're getting a lot of questions too. Well, what if you have a loan on machinery and equipment? I think on the non-for-profit side, we probably don't have as much of that. So I won't dive into the details there. I think really for this group, it's really a building and that mortgage on your building. Covered rent obligations, that's pretty self-explanatory. And again, what I meant to say kind of on the building, when I mentioned machinery and equipment, I meant to kind of say that under rent. If you're renting machinery and equipment and whatnot, does that count? Again, for this group, we don't have a lot of that issue since we're not probably renting a lot of machinery and equipment in the nonprofit world. So the covered rent obligations, you'll see is your simple rent calculation. And then covered utilities, we got a lot of questions on that. That's electricity, gas, water, transportation, telephone, as you can see here. And when we hear transportation, we believe that's essentially like gas for your vehicle. So that's this slide goes to really get into what's included in those forgivable dollars, and you can see what's laid out here. There are then some limitations on forgiveness, and when it comes to limitations, the first limit, well, first of all, your forgiveness can't exceed the principal amount of the loan. So if you got a loan for $1 million and you incur $1.2 million on forgivable expenses, your forgiveness is limited to the $1 million. The second thing to mention is number of employees. So this formula is complex, and I'm not going to get into the formula right now. But essentially, in plain English, if you decrease your number of employees during this 8-week period, you are going to see a reduction in the amount of forgiveness you're allowed to get. Now, just recently, the SBA came out with a frequently asked question that I like. Most of the guidance that's coming out, I don't like. It's not, client friendly. This guidance was great. It did say if you reopen your business and people refuse to come back to work, and we know that's going to happen because some people look and they say, I'm getting paid more on unemployment than I'm getting paid to work. But if people refuse to come back and you have to go through some hoops about documentation, then you will not be penalized when it comes to looking at a decrease in number of employees. So that's something that's very friendly to the company in that perspective. You can also get dinged in your forgiveness if you're decreasing people's wages by more than 25%, if that person was making under 100,000. So if you make under 100,000 and you decrease their wages more than 25%, you'll get dinged on your forgiveness calc. In the not-for-profit world, that probably won't be quite as prevalent, but another way that you can get dinged in forgiveness. And then you could try to restore your forgiveness by rehiring everybody by June 30. And again, these rules are way too complicated for a brief webinar. We can take some questions in the Q&A if we have them there, but that's kind of a general high level on it. So again, I just want to reemphasize, everything's changing. As we get more guidance on the forgiveness, we'll certainly host another webinar if need is there. Definitely consult your CPA and your lawyer to get help, and really get help on these forgiveness packages to make sure that they're in pristine shape. What we believe is if it's in pristine, we don't have any bankers here, so I'll say it on the call. We believe if it's in pristine shape when it goes to the banker, they're much more likely to kind of stamp it and keep moving the process along. So with that, I talked for a while. I'm going to turn over to Vicki, who I know is going to answer some more frequently asked questions that have come up over the last few days.
Right. One of the questions that frequently comes up, and I've seen it here as well, is how do you calculate the full-time equivalent, the number of full-time equivalent employees, which is relevant for determining how much, what was your employee retention level based on the 8 weeks after you received your funds compared to either, the first 2 months of 2020, or, there's about a 6-month period in the beginning of 2019 that you would use as your baseline for comparison, whatever's better for you. But the most statutes that have some concept involving a full-time equivalent employee will specify what the full-time, what is the hours for full-time. For example, under the Affordable Care Act, it's 30 hours a week. We don't have that guidance in the PPP. So what I would do is simply, to the extent you have developed a full-time schedule for your employees, if it's 30 or 40 hours, then you just look at how many hours you have in a payroll period, you divide it by 30 or 40, and that's your number of FTEs. That's how I would approach this until we get further guidance. So you're sort of calling the shots based on what your full-time level is for your organization. Jeff covered a lot of the things that go into the forgiveness calculation, which is going to be very, very important. But one of the things that clients have been consulting me on is, believe it or not, is whether or not they need to give back all or a portion of the funds they've received. And this has been driven by the guidance we got in FAQ 31, which I don't know if it was really a surprise, because I think we were all waiting for guidance as to what the certification, which I call the need certification, which is required to be made on the application, what that really meant. And that certification is simply that because of the economic uncertainty, we needed this money to support our ongoing operations. Well, what does that mean? I mean, the economic uncertainty that existed at the time, the certification must be made in good faith at the time that you submitted your application. Now, there was a great rush to put in applications. Nobody really knew what it meant to take into account the current economic uncertainty, and what does it mean that the loan is necessary to support ongoing operations. Does that mean that you need the PPP money so you don't have any losses? What does it mean? Nobody quite knew. Everybody just applied, and because everybody else was applying, everybody applied. Well, the FAQ in item 31 really kind of invites all applicants to revisit this. And what guidance they gave us is equally subjective. I mean, they said that you need to consider your current business activity and your ability to access sources of liquidity in determining your need. Now, I've heard a lot of lawyers take the position, and Jeff and I talked about this, that because the statute on its face said you will not need, we're waiving the credit elsewhere requirement, that really you didn't have to think about where else you could get a loan, where else you could get funds. This was a government stimulus action to give people money to pay payroll, to continue their ongoing operations. So when this guidance came out, it really took people by surprise, because they didn't equally, how do we assess what liquidity is available in this uncertain environment? But I don't really think it flies in the face of the waiver of the no credit elsewhere, because that's a historical requirement for all SBA loans. And really, it was something that the lender had to certify, that the lender would not give a loan to a borrower on the same terms that the SBA would, whether it's because of the tenor, the interest rate, the credit quality of the borrower. The credit could not be obtained from that particular lender. So the SBA would lend. Now, embedded in that test, but governed by a different regulation, was the sources of liquidity consideration. And the SBA would not make an SBA loan if the owner of the business, and again, we're talking about small businesses in the context of the historical SBA program, if the owner of that business, was a billionaire or had significant liquidity. And then you would have owners that are not billionaires, but they do have liquidity. And the SBA had a formula under which they would require owners to put in or inject certain capital into the business as a condition to the SBA loan. So historically, there's always been a view that the SBA is going to look at the financial wherewithal of the business owner. So particularly when this question of assessing liquidity came up, well, who do you look to? But in the context of nonprofits, you really don't have owners. You have endowment funds. You have other sources of liquidity. You have reserves and things like that may be looked at in this determination. But I don't really think that what the SBA was doing with this FAQ is changing the rules. And some people disagree with me. I think what they were doing is they were trying to address what factors they were going to look at in determining whether or not an applicant made this certification in good faith. So as it relates to nonprofits, when you first applied for this loan, the current economic uncertainty, and I think the current economic uncertainty is still prevailing, you knew that your costs were going to go up. You knew that the anticipated spread could close your operations, could close the people you serve's operations. There would be quarantines. You may need PPE. You may need to hire new employees because some employees may not want to work anymore given the circumstances. Program shutdowns with the social distancing. Donations are down. Payments from government authorities are slowed. All these things you're facing when you were filling out your applications. Now, some of these things may have come to fruition as we sit here today. Some of these things may still be coming down the pike. I believe that there's still a ripple effect that the economy has not yet suffered, and a lot of businesses will continue to suffer, as will nonprofits. We really haven't seen the full effect of what this virus is going to do. And as the states are opening up and we're out there more, who knows what's going to happen? And I think what an organization needs to do is really think about what other funds they do have available and what other increased costs and what other increased challenges they will have. I mean, it's a timing issue because you may have gotten your money in the last couple weeks. Things may not be that bad now, but to the extent you can use the funds to pay payroll now, it's conserving your resources for what may be, more significant challenges on your cash flow in the future days and weeks and months. So I know that Treasury has said they are going to audit every borrower who has taken down a loan of 2 million or more. I've had some organizations and businesses come to me and said, well, now that we've got the money, we're taking a look at what's really happening. Maybe we don't need all the money. Treasury gave us until Thursday, May 7th, to give the money back if we felt that we could not make the certification we made was not true when we made it. After reconsidering what Treasury says we should take into account, and that is, what are the factors that are currently facing us, our current business activity, and what other sources of liquidity do we have? I think you should look at your presentation to your boards of directors. You should reevaluate what other sources of liquidity you do have. Obviously, if you've got an unrestricted endowment of $500 million, you probably don't need this money. On the other hand, if you've got a humongous organization with tremendous costs and your liquidity is modest for whatever reason, you really need to hang on to that money. Now, I don't think that as I said, I've talked to organizations who have said, now, maybe we don't need all of that money. I don't think you have to give it back right away if you still have that good faith belief that your organization is going to be adversely affected, even if sitting here today it's not adversely affected. But I think that if you can and it was sort of an arbitrary formula to get this money. If you just look at your payroll, take 2.5 times and that's it. Well, that could be a big number if you've got a big organization. And if you want to give some of it back, you can give some of it back now. Do you have to give it back if you think you're going to need it all? Probably not. And, I've had some organizations who said, if they don't need it, they may well, and this is in the world of tax exempts, they may give it to funds where, I've talked to utility companies where they may give it to the fund that helps people pay utilities. There's a variety of things that might be opportunistic for a tax exempt to do with the money that would not be frowned upon by this program, because this program is really to help people, weather the storm. It is to pay payroll, and that's the primary focus. But I really don't think, if you keep a record and there aren't egregious circumstances, if you keep a record of how your organization is being affected and what you think is coming down the pipe, I think you're probably in good shape. And as I said, I know sometimes this is a very difficult decision to make. We have been asked to, as I said, we've been asked to counsel with a lot of people on this issue, and it's very subjective. So I think you've got to follow your heart with this decision, and just think of the record that you've made and the things that have gone into your decision to apply for the loan in the first place.
Vicki, I think that is fantastic advice. Thank you. We nonprofits love to hear thinking with our hearts. Makes us feel good. And unfortunately, this program obviously applies to others than nonprofits, and rules have to be built around everybody, it appears. But a lot of questions have come from our participants, both in the chat room and some submitted beforehand. So I think Don's got some of those prepared.
Yeah, I'll go ahead
Some
and
notes on some, and we'll throw
I've
some
been
in
trying to
later.
group some of them, but I'll try to hit the ones that. So first question, I have a client with 2 employees. One is on salary, 1 commission. The one on commissions had their pay drop significantly. Does this jeopardize forgiveness, or should PPP funds be used to compensate at the same level? Similar question on can hazard pay count in the allowable compensation?
Great question, Don. So of course, just like everything, we're not exactly sure yet. But I think when you look at that, especially the commissioned employee and the hourly employees too. So one thing I want to point out is, let's say you had somebody that was hourly and they were working 30 hours before, and they're now working 10 hours now. So they've had a decrease in their hours by 60%. So then theoretically their pay would go down by 60% if their hours go down by 60%. We do not believe, and I'll let Vicki chime in if she thinks something differently, we do not believe that's considered more than a 25% decrease in pay because you didn't decrease their pay rate, you decreased their hours. You might get caught up in the full-time equivalent rule later on, but we don't see that as a decrease in pay. When you asked about an employee on commissions, that I think is more of a tough issue, that if they were getting paid $80,000 before, and now they're getting paid 40, so they have a drop in pay of 50% because they're commission based. I do think you could possibly get tripped up there, and you've decreased the employee's salary by more than 25%, and potentially have a reduction there because their pay did go down. But the rules haven't exactly addressed that issue. Vicki, do you have a different thought on that? I'm curious to hear.
Yeah, my view is if you're paying somebody, let's say, commission of 25%, you're not reducing the percentage at which you're paying that person, but because of what's happening in the business world, it's just the compensation will go down, but it's not the employer who is responsible for the reduction in overall comp. It's the market. And I think as long as you keep the commission level the same, that's all you can do.
What about hazard pay?
I think hazard pay, we got to wait and see. That one's too hard to predict right now. I certainly believe you should be able to include it. That's just my personal belief. That's not based on any law. But I think we need to wait and see what the SBA clarifies there.
Yeah, that is a big issue. It's just like bonuses in my mind. Unless you're giving an employee a permanent increase in their salary, I think, I don't know. We're going to need guidance on that, because that question comes up, across the board with for-profit businesses as well.
And one thing there to mention too is, like, let's say you say, okay, I'm going to do hazard pay, and you do it for the 8 weeks, and then on week 9 you stop doing hazard pay, and let's assume the hazard is still there. You could be in a tough situation where they say, well, you said hazard pay was necessary, and you stop doing it after week 8. That could get tough.
Yeah.
All right. Next question. We have 2 staff members scheduled to retire during the 8 weeks of our PPP loan. We are not able to fill their positions right away. How will the impact on our PPP forgiveness be calculated? Then the second would be, if we fill their positions by June 30, are we okay? So they're going to 2 people are going to retire during that the PPP loan. How's that going to affect? That's the first question.
Well, hopefully we're going to get guidance on that, because if you rehire somebody by June 30th, you only get credit for that rehire based on the statute if that person was let go sometime between February 15th and 30 days after the enactment of the act, which was April 27th. So if you've got somebody who retires on May 15th, I don't know that it matters if you rehire them by June 30th. But if that person is retiring on May 15th, I think what you need to do is think about replacing that person as quickly as possible. So that person, you know, you might have a replacement very soon after that person does retire. So it keeps up your average monthly FTEs during your 8-week period.
Okay, if during the PPP time period, we hire extra temps from a temp service, which we do yearly for spring cleanup, can we add this amount to the calculation?
I would say yes. Again, they're part-time, so, you know, you'll have to cobble them together for an FTE.
Now, my only concern there is with that temp, if you're paying a temp agency for that, so it's not actually on payroll, there potentially we see could be an issue there because you don't have it in your payroll. It's going through a temp agency. Based on some previous SBA rules, we do think that that should qualify, money to a temp agency, but I'm not 100% sure that money to a temp agency would qualify. But if they're a W-2 employee, absolutely qualifies.
I see a number of questions about other types of expenses than payroll, and they seem to be into 3 categories. So in the utility category first, electric, gas seem pretty clearly to be utilities. What about phone, cell phone or cell phone reimbursements, trash, sewer, conference calls, things like that?
Yeah, great question. So I'm going to throw Don will circulate the slides afterwards. But the law very clearly said that the covered utilities was electricity, gas, water, transportation, telephone, or internet access. So if it's not on that list, I'm hesitant to say it qualifies. So you'll see, I guess sewer isn't
Part of water. Sewer is part of water.
You know, I think you probably have a good argument that sewer is part of water because it kind of seems like all the rest. It doesn't seem that different.
Right.
And how big could your sewer bill really be? But I think sewer, you probably have, telephone, if you're reimbursing the person for a telephone versus paying the person directly, I think you probably have a pretty good argument there. But again, the rules haven't specifically stated, but you still are paying for telephone. I think that answers the question. Did I miss anything?
Yes, it does. And the next one in that area is mortgage interest is clearly answered there. What about construction loan interest or interest that people see themselves paying on leased equipment?
So interest on leased equipment, I do believe will end up qualifying because it's personal property, but I'm not going to fully commit to that right now. And then interest on a construction loan, I haven't gotten that one before. That's an interesting question. I would think you probably have a pretty good case for that, but I'm not exactly sure because I haven't seen any rules that directly address that. Vicki, do you have a different thought?
Well, it's an interest in real property when you have a construction loan. There's obviously a deed of trust filed for security. So I would say that construction loans are fair game. And I would also say that, leasing capital, there's always, what is a lease indebtedness or what? But I would think that certainly you could deduct interest on the interest component of capital leases and any purchase money, equipment financing, copiers and the like as well.
And one last one here in a different category, but I think it applies to a number of nonprofits for sure. What about employer contributions to HSA accounts? Does that count as a benefit expense that would qualify?
I'm not excited about that one. I haven't seen anything that directly addresses HSA. Can you say that's part of medical? based on reading the rules. I'm a little bit hesitant to say that does qualify. I think that's a little bit of a tougher sell. I don't know, Vicky, if you have a more optimistic.
Yeah, quite frankly, I've never heard I've never heard that an employer gets a deduction for contributing to an employee's health savings account. I've never heard that one before. And I think it would be cash compensation to the employee. You know, I don't know. That's a new one on me too.
Okay. Question, if you don't spend all the money in the 8-week period, can you return the unused portion?
So yeah, at the end of the 8-week period, you'll do your forgiveness application. And at any time you can return it because it's just like, it's a loan. So you can repay the loan at any time you want. No different than any other loan you have. There's no prepayment penalty. So absolutely. And we know that quite a lot of companies or not-for-profits immediately after the forgiveness will return the unused portion so they're not paying interest on it.
This may not be as easy a question, but who makes the final determination that necessity was made in good faith? The bank?
So what will happen there is the bank will not make that determination because the bank's not required to. The bank just has to see that you filled out and signed your name on the certification. The SBA, or I guess in conjunction with the Department of Treasury, will audit certain applications. We know all applications over 2 million plus certain ones below, and they will be the one that would challenge that certification. So nobody's going to, you sign the certification and that's you saying I met it. It's just that if you get reviewed or audited by the SBA or Department of Treasury, they could challenge and make you prove that that you qualified.
I agree, Jeff. Yeah, I agree.
Andrew, you have a couple questions? Or you want me to go ahead? I'll grab a couple more here.
I'll mention real quickly on that, on the whole, did you qualify, did you need it? Bankers won't touch the question. They want nothing to do with it because the SBA told bankers that they will not be held liable if a borrower falsely signed that certification. And, you know, Vicky gave a wonderful talk about thinking about that certification, and especially if you have a large endowment. I could say I've talked to several very large prominent law firms, including, you know, Vicky, on their take on this certification and if you need it, especially if you have a large endowment. And I'll tell you, it seems like each firm has a different take on it. And we don't necessarily have, you know, convergence of minds on this one. So all the more important to talk with your individual attorney because it's like everyone's even giving different guidance, which makes it that much more difficult. And I'm not criticizing anybody, the same that everyone has a different view on it.
Right.
Here's an interesting question, I think. What would the penalty be if the SBA determined you did not qualify? Let's go with the in good faith rather than trying to rip off the federal government, however, you know, but they said, no, you did not qualify.
Well, you mean that you did not make there's two things. There's outright fraud, okay, where they're going to determine you did not make the certification in good faith. Again, it's so subjective, but you know, there are going to be, I mean, the Department of Justice can bring claims against an organization under the False Claims Act. There are whistleblower statutes which allow, you know, consumer groups guided by, you know, vulture plaintiff attorneys to come after different organizations challenging their certification on behalf of the government. And these whistleblowers can get commissions of 10 to 30% of what the government might recover, which would be the total amount of loans and penalties. You can also go to jail for 5 years. You can get fines of up to $250,000.
3 times, I believe, the loan you could get fined with.
Yeah, I mean, the penalties can be very substantial under some of remedies that the Department of Justice has and that consumer groups will have as, you know, in conjunction with these whistleblower statutes. So the penalties are pretty severe, but I think that that's why you have to think about and make a record as to why you were able to make this certification in good faith. I think that there, to the extent that you're represented by counsel, I think that goes a long way. To the extent that you've discussed it with your counsel in making this decision, I think that goes a long way. Your presentation to your board of directors should reflect the need for the money or the potential need for the money, something that demonstrates that you've thought through why the organization needs the money and what other alternatives there were to getting the PPP loan.
Look, we don't stand after a bunch of nonprofits and putting you all in jail. You know, that's not exactly the good press they're looking for. But, you know, we do know there's a lot of bad actors out there that are doing a lot of bad things. And those people are going to look at some jail time.
I'm just hoping they go after the public accountants first. So.
I told all my clients I'm not visiting them in jail. So
There you go. Let's see. There was a question I just noticed, and I think we may have answered it. Does the 75% spent on payroll costs have to be incurred in the 8-week period or simply spent on payroll, even if it takes 12 weeks to do so?
So when I read it, I like to say, yeah, you got to spend 75% on payroll, but you can do it over 12 weeks. I like to read it that way. So whoever wrote that question, I love it. However, right now that is not clearly answered. And I even talked to the lead SBA guy in St. Louis, and he wouldn't answer that question for me. And he said, you know, we got to wait and see. So no promises there.
But that shouldn't be hard to do based on that the loan amount is based on 2.5 times payroll. So if your average payroll has not changed that much from 2019, it should not be difficult unless you're a shuttered business or your organization has significant portions of their operations shut down. But even then, what people who are doing, who receive the PPP money, is they're paying people not to come to work. And as Muchin said, they viewed the PPP as a substitute for unemployment benefits, which is unfortunate because some people are getting more on unemployment than they would from their regular payroll. But I don't think it should be challenging to spend 75% of the amount of the loan on payroll over that 8-week period. Do you disagree, Jeff? I mean,
the next question, but I think easy for us practitioners to say in real life, I've seen a ton of clients that have had decreases in their payroll for one reason or another. I mean, there's other clients that have increases, but I do know a lot of people on this call are probably stressing about that 75%. And I recognize in practice, it's hard to do at times.
mm-hmm.
Okay. Just as a reminder to everyone, I know we're up against the 11:30 time frame. We have been taping, and I'm putting it in the link. I think I got it right. A copy of the tape will be on the Jewish Federation website, jfedstl.org. So you should be able to look at it and pull it down if you'd like. Are there any other comments from our presenters before we wrap it up?
I'll just end with reach out for help. You're welcome to reach out to Ruben Brown, and we're happy to assist. I know we have relationships with a ton of people on this call, even those that we don't have relationships with. We're happy to assist and get your advisors to look at your case-by-case scenario, and whether it's the forgiveness calc, making sure it's right, or this legal issue of do I need to return the money. Just reach out and get help. We're all here and happy to assist as needed. And we're happy to come back and present again once more guidance comes out. If Jewish Federation and United Way would like to continue the series. So thanks everybody for spending the time with us today.
And I'd like to thank everybody too in the organizations who are sponsoring this. I think it's This is a very difficult program to understand. It was rolled out very quickly. Hopefully it accomplishes the purposes it was intended for. Sometimes I question that, but there are going to be more questions you're going to have. You can feel free to reach out to Thompson Coburn, you know, on any of these issues. So everybody have a good day. Thanks very much.
Thanks. Yeah, Vander?
Thank you for your time.
I will just say thank you for all those participating on the call today and who called in. St. Louis has a wonderful group of nonprofits. It's nice to see the arts organizations, education organizations, as well as the health and human service that we normally deal with, all wrapped up today. So thank you all for attending, and best of luck to everybody during these times with your PPP loan and with all the other interesting things that we've got going on. So best to everybody.
Thank you, everyone. And
Thank you for your time.
thank you very much. Stay safe.
Ditto. Bye, everyone.
Bye-bye.
Bye-bye.